Hey, Market Sniper here, coming to you, talking about gold and silver. Bad spell for gold and silver recently, coming off down. Gold-silver ratio running very strong up. We'll have a look at those charts. But what do rates in terms of rate increases truly imply for gold and silver's progress? And are we facing a situation where recent rate rises that have taken us up into close to previous highs are putting a little bit of a dampener on the potential for gold and silver? Let's go into the charts and have a little look further. So here we have the United States 30-year government debt. So this is all about dollar. Is the dollar going to be strong? Is rates going to be climbing? Generally, if rates on the dollar are climbing, and if they are particularly climbing faster rate, that means speed rate, than other national currencies such as Euroland, which is a big alternative seesaw, as we've mentioned, good for dollar, bad for euro typically, or any other major nation currency rate increases, then what you could find is that you get a headwind of dollar strength. But are we really going to get a headwind of dollar strength? I'm not so sure it's going to be so cut and dried, because rates are probably also going to rise or need to rise in other debt instruments. So why are we talking about debt when we want to talk about gold? When gold go up? When silver go up? That's what everybody wants to know. Well, I maintain that we will have potentially a very good structural setup coming for the beginning of September stroke final days of August, and that possibility exists. But why is it doing so badly now? Silver got slammed. Don't forget, it was in the mid 25s not so long ago. Now it's 22.8. That's quite a slam. It's gone low. It's gone real low. So we need to look at a few charts. So as we're looking at this 30-year debt chart, you can see that we've actually got a squeeze structure that implies for rates that the next major move for us, certainly in terms of our draws, you've got a big, slightly complex M there, and then the squeezy that you broke here, and you then formed a falling wedge. We've continued to assert debt needs devaluation. How do you devalue debt? You have to pay a higher yield to get a reducing pool of buyers interested to buy. In other words, you need to get the rates beyond that of people's perception of inflation, which could well be beyond what the Bureau of Labor Statistics actually says inflation is. Don't forget, you've got roughly a 3% year on year compared to a very high year on year a year ago at 9%. So you're 3% up on a previous 9.3% 1 year before. But it's still up on what was a very big climb during that month. So people are starting to price in much higher levels of interest rates going forward generally. And this is the beginning of the great debt deflation. And it's in fact our hypothesis, and has been for a long time. The debt cycle turned in 2020. We were very much all over this in August. No one was seeing that. Everyone was by the damn dip on debt and the equity markets. And now more and more people are started pricing in the fact that deficits are running crazy. Money is having to be created to meet shortfalls on declining tax income, increasing interest payments, and you don't get to turn this Ponzi around and go all the way back. A major reset moment will occur probably on an interest rate spike in an environment where there is an absence on bid on buying the most proliferated product ever created, debt, which is money. It's the other half of borrowing into existence the money that you use. So we expected a rest going into the payrolls number on Friday, and we were getting up to our second interim here at 4.29. We expected a small pullback on there with the labor numbers that were provided. You had actually had a very strong spell of move up that has been leaning both on Bitcoin and on gold. Remember, Bitcoin officially, certainly, and the crypto markets, although people can argue the DeFi markets are still struggling to establish themselves, but generally don't pay an interest rate, and neither does gold or silver. So here you are having an investment category that is increasing its yield to you in a bid to make itself more attractive as it gets cheaper. And we're having a pullback here for now. However far this may go down, our eventual expectation is at some point you will cross the 4.75 on the 30-year government yield. We've called for this for an extended period. This technical pattern has looked good for us for an extended period, and we've continued to bias for higher interest rates. This will also have an effect eventually on stock markets where there's corporations with borrowing. They're not going to want to take new debt, certainly, so they will certainly be hunkering down, and their existing debt is going to get more expensive. But we talk about 360-degree analysis. What about the other debt markets? Before we turn to the gold and silver charts, what about the other debt markets? Are they going to maybe go down? Well, again, I'm going to show you a particular technical structure that has occurred. This, by the way, very classical rounded bottom type structure. We've got a smaller little squeezy in here that we expected to make target and did. It made its target, had a pullback, and is now making a higher high, but has just had a minor setback, along with the pullback post the payroll numbers that were a little bit limp and weren't pointing to such a strong labor economy anymore, as per the Fed's assertion that we're not in a recession because the labor markets are so strong. You might notice that this here is our W structure that we've drawn, and we are forecasting for a 4.9 on the 10-year, which is heading to the doorstep of the 5. By the way, this blue line that I've just drawn over with the fat blue line is in fact the 4%. You see the box number there? That is the 4%, taking you to the doorstep of the 5%. Isn't that typical? Where else did we see that happen? Well, I've shown you in history in 2009 how you were just running and bouncing on the $1,000 mark, and then you ran to 1900, taking you to the doorstep of the next 2000, which we're still at today. Just technical runs, but no holding above on the monthly chart on the 2000 level. And what is our target for the next move? 2,900. Not because of that rule, it turned out technically, but it makes sense that there will be a pause before the key structural pegging, and pegging is a concept where derivatives with round numbers have strikes and options, etc., at key round levels, and 4 and 5% are very, very strong levels, in the same way $1,000 gold, $2,000 gold, and $3,000 gold would be in a derivative market too. So with all of that about debt, let's have a look at it. Before I leave the debt market entirely though, how's it been looking just generally on the longer time frame, because those were both daily charts? This is the turn, in our opinion, of the debt market in terms of its lows. In fact, this was a 40-year, we need to almost go to the monthly here, a 40-year bull market since the Volcker era that took you right back into the early 80s of extreme rates. We could not survive at rates of such height, and well before attaining such a level, we would already have faced a financial reset and be presented with our new system for the new era. That's right, they are working it, they are parallel running it. The old train is getting rickety on the old railway lines. They have a monorail running alongside that they're already testing, that is still covered in the nice new plastic sealant, ready to be unpeeled and unveiled as your grand solution after a major crisis that destroys the old system. How do you shoehorn everybody into the new? Well, you first give carrot, and then eventually you stick, you break the old. So this rate cycle is going to go higher in our view, and the 5%, what do you think that's going to do for property market prices, for people's feeling of wealth, for people that borrow? We've seen credit card debt has contracted, although consumer credit is still expanding in the US. It's of course one of the most expensive credit card debt. So the pinch is on. The other interesting point is, what does this do for the dollar? Generally, I'm going to show you, because it's interesting to know what the dollar does. So why we talk about debt, why we talk about the dollar in terms of understanding gold and silver. Because the gold is the god market of the anti-fiats. The king fiat is in fact the dollar. And right now, you're sitting in an environment where generally the 30-year US minus the European. So I'm actually taking how much the American market has increased relative to the next major significant currency and European market, its rates, and what effect that has had on the strength of the dollar. Unsurprisingly, the dollar gets stronger in an environment where its rates are going up faster than the Euroland. Bearing in mind, we have the BRICS nations that are going to talk and tell you all about their great new trust us, we'll be more honest than the other guy with their non-convertible, almost assured. No one wants the discipline of convertibility and gold, but they will do some form of backed version of a currency, presenting it, or suggest one is on the way at least, and presenting it. And one of the key things about the dollar is whenever it faces a new rival, they typically plan a period of strength. A period of strength, that's right. They like to still say, we're the biggest and strongest primate in this park. They did that during the euro. The euro launched well above the value of $1. I think it was around 140. It fell to 80 cents in a steady undermining of the euro. And dollar dominance policies were pursued. So in that same vein, with the BRICS doing their announcement, rather than it having this explosive, amazing initial run of pure vitality and strength, whatever they might announce, whether it's actually released or just intentions to release, it's quite probable that it'll run into the policy of stronger dollar. At the same time, those rate increases will also help to devalue an ever-burgeoning pool of debt. That's right. Whilst more, of course, is being created and minted at the very same time. The abundance of debt is beyond all parallels, my friends, and assures that the system will not succeed. So we've shown you here that the differential between the two rates is typically given a dollar proxy of strength. So with that all said, let's go back and have a look at the gold and silver charts. So here we go. So I brought you to the daily, and what you can certainly see is there's been a steady skidding into lows here by the dollar. Little rallies skidding off, little rallies skidding off, little rallies skidding off. I have also pointed out that the last period where we scraped above 2000 was in fact a broadening structure on a bullish pole, which is typical of running out of steam and puff. Quite typical to have 3 rejections before the fourth and final move breaks and stays above the 2000K. It was very similar to that on the $1,000 mark. Let's actually have a look at those other 2 periods where we actually crossed the 2000 mark so that you can compare them. There you go. We had a very strong pullback in the second event. This, of course, was in the face of 4 by 0.75% rate hikes that were well signaled and a very hawkish stance. This brought gold right the way back down to 1600 after breaking right up to around the 2060 levels. So interest rates being baked in on an increasing tightening cycle generally are not helpful. However, there comes a point when debt and money become questioned and the value of it. And everybody realizes that this could go a lot further and you could have far bigger spikes and that the system will fail. At that point, the value of holding a physical in your hand piece of metal that has no debt associated with it, unlike money that's been borrowed into existence, it has no intrinsic liability associated with it, you own it, you've paid for it, and it's in your hand and it can't be taken, eventually swings and can climb in a collapsing environment. We have yet to meet that flippening point. However, I would suggest to you that a very strong move could occur the next time we breach the 2000K. So here are the previous times, number 1, number 2, and number 3, all of which, in fact, not both, showed exhaustion afterwards, with the longest and hardest sell-off on the second time into the teeth of a very aggressive interest rate commitment cycle of hikes. Now we're having probably the smallest pullback so far, but we are continuing to skid into lows. Why? Because everybody who's called for the great pivot, and people are pivoted callers, are going to continue to exist, and I think they fail to see that debt can never be at the previous valuations that it once held, on account of the inflation levels that are endemic and well set, and on account of the proliferation of debt in the system. So that's the gold on the lower time frame, currently pulling back, but at some point I would imagine there will come some degree of bid once all the interest rate hiking that is expected has been baked in. We can see against the euro, there's also not yet a bottoming that you could put your confidence in. I wouldn't say that, and you've been skidding again into lows over here against the euro. The gold has had a great period against the Japanese yen, of course, we've discussed that at Liberum, but you can see also, having made a multitude of targets against the yen, it is now in a far more choppy state. The yen being our currency of short of choice. And if I just show you on a bigger time frame, boy, if you want to understand the value of gold and you are Japanese, this is what you've had, non-stop. And by the way, I showed a clip quite some time ago, back in 2017-18, where we were highlighting that precious metals, particularly against the yen, were going to be outright overperformers. And this was the trumpet that we gave you. And since then, you could have got in as low as 127,000, I apologize, 127,000 yen for an ounce of gold, right the way through to 276,000. So you're about two and a half times from 18 to 23, 5 years. Boy, oh boy, does that save the Japanese people who took the right appropriate action at that time an immense amount of money. Lots of HVF structural setups all the way along, and this is one of our key favorites. It's almost like trading the USD Turkish lira from a decade or so ago. It just keeps on giving you setups. But you can see even here, little bit tired and a little bit rounding out for gold. So I'm not expecting an amazing week ahead or even 2 weeks ahead. I would imagine we're going to be needing to look at the very tail end of this month and September and have a look if things have set up a little better for the metals. It's quite possible, with the hikes coming on flow, that metals stay out of favor. What has happened on our gold-silver ratio? It's worth pointing that out. We've had a very steady and strong, I might just take the eye off there just to show you there, lots of alerts. This is one of our key benchmarks that we watch for risk on and risk off environment, and the degree to which there's appetite, even for cryptos, never mind just precious metals, depending on the confidence in the dollar. When this breaks down, it represents a loss of confidence in the dollar, and it remains our expectation that that will occur in this broadening structure. However, right now, you have just faced, on a weekly time frame, 4 back-to-back weekly periods of upside move. So we are going to have to see how, in fact, this sets up. Will we get a squeeze here, and will we be turning down soon? Or will this continue to raise up and up and up and give us some form of new structure that will have us change our current scenario cost? So without turning down fairly soon, the minute it runs this high, we will say our expectation of a downside inverted HVF, as in this zig and zag like that, ceases to hold on the takeout there. That means some new structure which will have to be evidenced, and it pushes out the bull market in silver and gold. Something the precious metals people will not be happy to hear. However, we will see, and that's why all those alerts are on there, and we remain open to see it. What's been particularly disappointing is the performance of silver, which has fallen really, really hard. I did want to highlight, this was not particularly optimistic price behavior. It showed quite a degree of volatility and somewhat of a marginally higher high here, and it doesn't surprise me that things are not going to plan, again with on the weekly time frame up here, 4 concurrent weeks downside that could even run that low if it were to continue. That remains to be seen, but let's keep an eye out. We clearly want the 26 level to be breached for this potential setup to occur. Right now, that is not looking particularly on. In fact, you may make a lower right shoulder. If you make a lower right shoulder here, there was some complexity, as we refer to it, in the left shoulder. So you had a bit of a double U left shoulder. It's quite possible you get a form of W again on the right shoulder. But we only really get excited on the break of the 26 level in dollar terms. And right now we're heading in the wrong direction and some safe $3.3 off reaching the 26 mark. So it's not about to happen just yet, friends, I'm afraid. So the targeting for the major move is being pushed out by a combination of dollar strength and rates, the likelihood that actually more rate hikes are going to occur. The debt market is going to continue to lose value and push upward pressure on rates, which is going to give a headwind for precious metals. So that's our take. Do I have anything else to share with you with regards to the economy? My overall opinion is I shared in our Substack. Don't forget we have a Substack. You can go subscribe there. A couple of charts that point to a real weakness in the general economy. We're going to get Tavi Costa on. I think it's tomorrow. We'll probably have content released with him. He's been sharing some great tweets on this. Of course, the US got a downgrade, which is again likely to push rates up. In other words, you're not so good for it as you say you are, Mademoiselle Treasury Democrat. No, sirree, you are not so good as you say you are. This is going to put deficit pressure because the interest rates payments go up. And this is one of the items of many that Tavi was highlighting. Local income tax receipts going down. The people are being crushed in what is a difficult economic set of circumstances. They are paying less tax because they're making less profits. The government has higher interest rates to pay, and therefore they have greater deficits. That means new borrowing, more new borrowing to cover the hole. So they live beyond their means, and now the income has dropped further and they're spending more. So they're now living even further beyond your means. So imagine your credit card if you were doing that. Well, that's where the economy is right now. Something else on the corporate bond yield that Tavi was also highlighting is, you know, major dot-com lows when corporate bond yields that should have a premium to them are getting ever closer to the Fed fund rates. There isn't the ability to push up the rental costs on those corporations. The Fed fund rate is getting higher. You typically have a correction in the stock market. That's the S&P 500 in white. Big correction. That, of course, was the dot-com boom. It was flagged, as he's illustrating over there in the pink box number 1 by the extreme low. Pink box number 2 was, of course, the subprime event. That was what that did to the S&P during that period. And you had extremity of variances in corporate bond yields and Fed fund rates, because the Fed fund rates then got cut super, super low, basically zero. So corporate yields then expanded greatly towards that. Reinflation all the way up, all the way up. Then we got to the CV19 event of March 2020, a sell-off there in the equity markets that was quickly stopped and patched up with a major, major proliferate that caused a blow-off top of around 60-70% increase, in some cases 100% on the NASDAQ plus. We're in a pullback now, and you are now at, friends, the lowest level of all 4 crises. Remember, this is the not a recession, and this is where you are at the equity level. My question is, do we get a correction and a major event coming soon, and will this expand back up as they are forced to cut rates? Well, I think it goes worse before that happens. In other words, rates need to get higher and more pain. I've said to you, you're going to have your waterboarding for much longer this time. You're going to be gasping for air and inhaling that water and coming up choking. There's not going to be quick relief on the same scale. They're going to use last CV19 experience as we created inflation, we have to worry about inflation. Talking of precious metals, we also shared in our Substack, which is under the Market Sniper Substack, go search there, feel free to follow. If of course you go to our website and you get our free mini series, you are included in this as an email alert that goes out even before the Substack. So go to themarketsniper.com and check out our mini series on wealth building and trading. What you'll see is, and I've highlighted this, the Palladium crash of the 80s very much coincided with the recession. I would say that's one large recession that, of course, again, was interest rate driven in the Volcker years. He really turned the screws at a period that money had got too cheap with the Vietnam War and Nixon and the decoupling from gold. You had the 1990s recession that threw Bush out, Bush Senior not getting a second term. That ushered in the Clinton era, a major correction there in Palladium and also a recession. A huge correction in Palladium over here, 2000, that was the dot-com crash. You had the same again in the subprime. It's one of, as an industrial, expensive precious metal, one of the best indicators. You had a fairly significant sell-off there that was coinciding with the 2016 year that many people don't recognize as being a very soft year, because you were still in the very low interest rate environments of the post-subprime crisis, and you had China that had been creating all the heat in the economy that suddenly got very indebted, and we had the lows of the Shanghai Accord. Palladium sold off badly then. And now you are in the current environment, which has a bigger sell-off than 2016, probably getting equivalent to the subprime sell-off, not yet the dot-com, but bigger than the 1990 sell-off already, and it is part of your not recession. Okay, Palladium is used in, as we probably mentioned a couple of times before on the channel, catalytic converters and other very specialist, high commercial, industrial needs, of which exhausts are probably one of the biggest of that. So that gives you a little bit of a feel. So Palladium is down. So actually right now, gold is overperforming the likes of Palladium and the industry, which says as a money alternative, it is doing better than the industrially demanded aspect of the metals as such. So let's have a look at a chart like that. This is gold. We're going to show you gold against platinum. So this is platinum first and then palladium. So platinum and palladium are part of the same group of metals, the platinum group of metals. So I'm doing both, and I will finish on palladium here. You can see that we actually see a relative upside valuation of gold against platinum in spite of the fact that gold is not doing that great. In short, platinum is going to do less well. And when we have a look at palladium, you'll see it's probably going to be the worst of the lot. This is an upside structure that is already seeing gold outperforming against palladium in quite a substantial way, and in fact it's close to making a target in relative valuation. So you can see not so long ago, March 22, gold divided by palladium was 0.586. Palladium was worth more than gold. Now we are in a situation where palladium is 1.577 less. So gold is 1.5 times, 1.6 times larger, and then looking for 1.75. So by the time it's run that, you're going to be closer to the price of gold being double palladium. So you've gone from being 60% to nearly double. This is illustrating the value of positioning and is showing that the monetary value of precious metals gold is outperforming the economic need for industrial use for palladium. We don't have palladium Rolexes, I'm afraid, and it's less used as a jewelry and more used industrially. So this is particularly highlighting economic weakness as well When we proliferate fiat, you tend to see these flip, and you tend to find this exceedingly rare metal. The platinum groups of metals are exceedingly rare. Compared to gold, they're exceedingly rare in terms of total mined availability. Okay, we've covered quite a bit here. So that's the outlook for the precious metals. Not that great initially, and the threat of interest rate rises actually hurts. And when a crisis, and I'd say when, because it's almost assured occurs, you could see initially a dip, but the resultant cure, if it leads to any quantitative easing or any reduction in rates, will likely take us through the 2000 mark. In the event that there is no immediate crisis, I still suspect gold could come off a little bit. The next time, however, it crosses the $2,000 mark, I would expect it to treat it as support and be the fourth time being the final time. In other words, only technical dips through on the 2000 level before advancing a lot higher and beginning its journey to that prediction of 2,900 that we've given, which remains valid because we have real macro technical bull flag targets that generated that, none of which have been invalidated, but are macro technical assessments that take time to occur. Okay, thank you very much for watching. Remember, you can book a call to come and join us on our precious metals, when to buy, when to trade, potentially to maximize gains. At the moment, not any long trades going down on gold and silver, but they may come about on lower and smaller time frames in a turning event. You can book a call from themarketsniper.com to become part of our community, where we are looking at all markets in this environment, which includes energies, commodities, equities, and all traditional markets, and of course even the crypto markets as well. Thank you for watching, and I'll catch you later. Likes and shares are real currency. We appreciate it. Thank you for doing so. Bye.